And so I think that's a misconception that people have. At the same time, I also see people that say, hey, spouse is going to enroll herself and the kids, and then I'm going to enroll myself on my employer plan. And so that's the correct way as far as like becoming covered.
So again, welcome back. Excited to have Brian Tolbert again with us. So Brian, as we switch over to the employee side of benefits, and let's just say that we've got a new employee with a firm. They're trying to make sense of the best path that they've got. Let's say they've got a handful of different options, that they can go towards. First, what should they be aware of with what's typical of what a firm will offer in terms of health insurance? When will they be covered? How do they go through that process, and how do they even select a plan? What should they be thinking about as they kind of come on board with the firm and think about their health care?
The Affordable Care Act required the waiting period for a new hire to not exceed 90 days. So the most you'd have to wait is 90 days. Employers, let's say they hire you on the 17th of a month. If they make you eligible for benefits exactly 90 days later, then you would become eligible to enroll in coverage in the middle of a month. And it makes the employer's invoicing kind of wonky. And so what most employers have done is they've made their waiting period first of the month following 60 days. That means that, even if you get hired on the 17th, your first date of eligibility would be the first day of a month. So following that same theme, I guess, we're also seeing employers use a first of the month following 30 days or first of the month following date of hire. So that's typically what we're seeing. The trend, or the way that I would think about, well, which one should the employer use? Typically, employers that expect higher turnover, they're going to have a longer waiting period. Whereas employers that have maybe more of a steady workforce, they're going to have a shorter waiting period. And this is more of just an administrative consideration that the employer has. Once they enroll, some employers, believe it or not, are still handing that new hire a booklet and paperwork to complete. And so then, the employee takes it home and reviews it with their spouse and makes their elections, and hopefully remembers to include their children's date of birth and social security number. And so that's certainly alive and well, and still happening. Many employers have moved to sort of an HR platform or an online enrollment platform of some sort, which requires that the payroll or HR team to quote unquote add that new hire. That way the employee can review the benefits online with their spouse, enter all of that information directly in the system. And then probably the third and even more common is that same experience is also embedded and being done within the payroll system. So what that does is it means that whatever my deductions end up being, they automatically populate into the payroll piece. And so that's typically the experience we're seeing employees have, and what to expect when they come on board as a new hire.
So if we fast forward, let's say a few months or maybe within that first year, if an employee makes a decision about health insurance that maybe they want to review, or maybe it wasn't what they expected, is there typically a time period where they can make a change or switch, and when would that tend to be?
Just right off the bat, employees have up to 30 days after their effective date to enroll. Most employers won't tell you that because, again, it's going to mess up their billing if you make changes. If you enroll and then they enroll you, they update payroll deductions, and then you, on the 25th day after your effective date, you want to change. But technically, you are able to do that. Then anytime throughout the year, you can have a qualifying event. You can Google qualifying event. There's 9 or 12 examples. But this is the kind of thing where you got married or you got divorced, you had a child, you moved. These events are going to allow you to, in the middle of the year, make a change to what your elections were. And then finally, your employer is going to have an annual enrollment period. This aligns with when their health insurance contract renews. 65, 70% of employers are going to renew their health plan in the fourth quarter, specifically January 1st. So it's typically what we'll see. But oftentimes many employers will, there's a May renewal date. And so as you're leading up to that May effective date, you'll have an open enrollment opportunity to make election changes.
How many of the plans, or how typical of the plans is it that you have spousal coverage or coverage for an entire family if there's children involved? What, as you walk us through this, and this is probably even helpful for folks who they're exploring a couple of different options in terms of where their employment might be. What is typical of maybe those health insurance benefits that are offered, and how far they extend maybe to family members?
We are seeing employers use either 2 or 4 different, they call them tiers of benefits. So the election ends up being either employee only or family coverage. So that would be a two-tiered benefit. So even if it's just you and your spouse, you would elect the family coverage. The four-tier structure is employee only, or employee plus a spouse, or employee plus just children, or the entire family. There are pros and cons to each. Obviously, if you have a two-tier system and you're enrolling your wife and kids, then the premium will be a little bit less than if it was a four-tier system, just because of the way the premiums are spread out. Obviously, if it's just you and your spouse and it's a four-tier system, you're just going to be charged for those two people. So there's pros and cons to each. Much larger, and maybe the idea of lack of engagement around your benefit strategy. That two-tier system is still alive and well, but many employers have moved to the four-tier.
Because I guess that there are so many different paths that we have in this world with different configurations of family work and benefits and number of kids and all those kinds of things. That does make sense that there's a little more selection, optionality there. If we think about someone who is looking at different options that they have, and let's say we've got someone that's mid-career making a change, is highly desirable to employers, and is being courted by a number of different institutions, and let's just say pay is fairly comparable among them, and that these benefits are a really significant piece of an overall package for just, in this example, let's just say it's a family, and you've got, one spouse that the health insurance will be a critical piece to. What kinds of things should they really be honing in on as they evaluate different insurance packages?
The very first thing that people typically look at is a payroll deduction.
Okay.
Right? How much is going to come out of my paycheck to enroll in this plan? The second is going to be the benefit itself. Like, what's the deductible? What's my liability, in a given year? I think on the employee side, I think they need to be more thoughtful around considering the different plan designs along with the payroll deductions. So oftentimes we will see employers that are offering a base plan, so a higher deductible HSA eligible plan, and then a buy-up plan, so no HSA opportunity and a lower deductible. And that buy-up plan, it costs more through payroll deduction. So let's say it costs $100 more per month to enroll in that plan. Well, oftentimes it makes more sense to buy the cheaper insurance. So buy the HSA eligible plan, but still spend the same amount of money. And the way the employee would do that is take the $100 of premium savings and go ahead and fund their health savings account. And that's really the better apples to apples comparison that employees should be taking when they're considering their different options. And so I think, again, it goes back to that lack of engagement and lack of understanding of how it all works. But anybody's HR department or their broker could help the individual walk through that calculation. But typically when people do that, they conclude ultimately that the higher deductible, the lower payroll deduction, and then taking some of that saved money and putting it into an HSA is usually the better option.
So I guess that facilitates a level of choice and also just, a focus on what they're paying for kind of along the way as well, because they're going to be paying a little bit more along the way for those benefits. But to your point, that level of engagement, it sounds like it also encourages that.
Yeah, I think that level of engagement, with an HSA plan, you don't have copays for your prescriptions. And a lot of people think, oh, that's no good. I would rather just know that it's a $35 copay anywhere I go. Well, what they don't know is that CVS and Walgreens is the most expensive place to get your prescriptions filled. And even though you're spending $35, the plan is paying the balance. If that engagement goes up for employees and they're paying for their prescriptions and they say, oh my gosh, the cost of my prescription is so much more at Walgreens or CVS, there's behavior change, right? The employee all of a sudden is going to go to Target, or they're going to go to Walmart, or they're going to go somewhere else to get that prescription filled, which means it lowers the overall spend on the same drug, which long-term is going to lower the cost, the outlay the insurance company has on your behalf, and lowers premiums in the future. But again, it's that engagement level. Some people just want the peace of mind knowing it's $35.
When we think about kind of what's typical, if there is a typical, what kind of range are you seeing, in terms of the amount that an employee covers and the cost of that base insurance? What would be kind of a typical range of, say, the percentage that might be involved in that payroll deduction?
Yeah, again, I think it's 80%. I think the most common strategy that I've seen employers introduce is they pay 80% of the cost of the employee-only coverage on whatever the cheapest plan is. That's typically what we walk into. Now, that said, it's becoming more common to see the employer move to what's being referred to as defined contribution strategy. So this is an idea where employees don't appreciate or don't understand what 80% of the premium is. And so the employer says, hey, instead of paying 80% of the premium, we're going to contribute $385 towards the cost of your insurance. We've offered a few plans here for you to choose from. You pick the plan that fits your needs. What that does is it makes the benefit that the employee is getting a little bit more specific, right? It's that cash, it's the money. But then from a cost structure standpoint in the future, the employer is, if they increase that contribution in future years, they're able to go to the employee and say, hey, everybody, you're getting a healthcare raise. Last year we gave you $385. Now we're giving you $400. And so the employee perspective is, hey, that's better. Versus the employer that has always given 80% every single year. There's this feeling from employees like, you're not improving the plan, you're not doing anything better. And so we're seeing more employers move to that defined contribution.
That same line of thought, what are you see, any other things that you're seeing that are either new features or benefits that are being offered by employers, or regulatory changes or things that here over the last year, 18 months, how is that landscape changing, if at all, for employees, and how should anything that you would advise folks be thinking about with respect to those changes?
I don't know that we're seeing very many changes from that standpoint that the employee has any decision-making authority over. At the end of the day, the employer is going to be the one that defines what the benefit is. We're seeing more employers want to offer more benefit choice, more options to their employees, but the employees themselves are not going to have a say over what's offered and what's not offered.
A lot of our clients, they are nearing retirement, or some of them are in retirement. Some of them think about coming back to work, or they're just happy as lark in the work that they're doing, and they're post age 65. Are there things that change once you attain the Medicare eligible age, but you're still in the workforce, and let's just say you're still fully engaged as, say, a W-2 employee, still doing full-time work? What changes should folks anticipate as they attain the age of 65, if any?
Yeah, it's a good question. I sort of joke with employees because I have this conversation a lot with them that as they approach or once they, become Medicare eligible. Medicare is a good deal, and it should be a good deal because you've been paying for it for 40 years.
Yeah.
So there's been a deduction out of your paycheck every pay period for 40 years.
Sure.
And so it is a good deal. It's a great benefit. The challenge is the employee is accustomed to the plan that they've had with their employer also for 40 years. And Medicare is different. Like Medicare works differently. And so I think oftentimes the employee, they take great peace of mind of knowing how their plan works and understanding it. Medicare hasn't done any favors in the way that Medicare eligible people are marketed the Medicare benefit. They just get inundated with all of this mail. They get phone calls from people, and it's overwhelming and it's stressful. And so typically inertia becomes very, very powerful, and they stay on the employer plan. But again, Medicare is a good deal. You've been paying for it for 40 years, and so it does make sense to take some time to see if it's a good fit for you.
Well, we've talked about the importance of engagement. Anything else that you would suggest? If you said there's one thing that you see people maybe could improve about the way that they look at their health insurance coverage, anything else that you would add here?
I would maybe specifically pick on dual income families. This sort of thing where me and my spouse both work and we're both offered insurance, and it's the sort of thing where my wife's plan, she will enroll us in family coverage, and so I'm covered there, but also I'm going to go ahead and enroll myself in my employer's plan because it's better to have double coverage than it's silly. It's just not the case. And so I think that's a misconception that people have. At the same time, I also see people that say, hey, spouse is going to enroll herself and the kids, and then I'm going to enroll myself on my employer plan. And so that's the correct way as far as like becoming covered. But what you've done is you've unnecessarily expanded your potential exposure to healthcare costs. And the reason that is because your family deductible, it's for the whole family, right?
Yeah.
And so if you've got 3 people covered on a spouse and then I'm covered over here, well, now I've got a family deductible and I've got my own deductible over here. So that doesn't really make any sense. You should really get the full family unit on either the husband's plan or the spouse's plan. and you make your decision, of course, based on payroll deductions and what the plan design is and that sort of thing. But double covering or alternatively, carving everybody up typically is not the right way to do it.
I think that's really helpful because we see that from time to time, and sometimes we'll just see total double coverage, which is even more of a head scratcher. But because I would presume that one of those qualifying events would be, if we did have, say, spouse A, family is covered there. Spouse B elects no coverage. That if spouse A loses employment, that spouse B would then be able to enroll. Is that fair or no?
Yeah, exactly right. Again, it's a qualifying event. One of the qualifying events is loss of coverage.
Okay.
And so if the spouse loses their coverage, then that would trigger that event.
Well, Brian, again, thank you so much for participating and giving us the wealth of expertise that you have here. Again, we're delighted that we've been able to work with Zach and Brian and their teams over many years, really to bring confidence and rest to clients' financial lives so that they can focus on those things that do bring energy in life, which tends not to be how to figure out what Medicare plan to pick or employee benefit plan. Zach and team have done a fantastic job, and of course Brian as well in the broader company. So thank you again for helping us today.
Sure, absolutely.
If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.